This is Ansar Hadi. Now we are discussing about insurance annuities basis. Now we are discussing about the in journal annuities have the following feature: tax deferral on investment earnings. Many investment are taxed year by year, but the investment earnings, capital gains, and investment income in annuities are not taxable until the investor withdraws money. This tax deferral is also true of 1401 and IRMs. However, unlike these products, there are no limits on the amount one can put into an annuity. Moreover, the minimum withdrawal requirements for annuities are much more liberal than they are of 401 KS and IRMS. Protection from creditors. People who can own and immediately annuities, that is, who are receiving money from an insurance company, are afforded some protection from creditor. Generally, the most that creditors can assess in the payment as they are made, since the money of the annuities owner gave the insurance company now belongs to the company. Some states and court decisions also protect some or all of the payment from these annuities. A variety of investment options. Many annuities companies offer an array of investment options. For example, individuals can invest in a fixed annuity that credits a special interest rate similar to a bank certificate of deposit. If they buy a variable annuity, their money can be invested in stocks, bonds, or mutual funds. In recent years, annuity communities have created various types of floors that limits the extent of investment decline from a increasing reference point. Tax-free transfers among investment options. In contrast to manual funds and other investment made with after tax money, with annuities, there are no tax consequences if owners change how their funds are invested. This can be particularly valuable if they are using a strategy called rebalancing, which is recommended recommended by many financial advisors. Under rebalancing, investors shift their investment periodically to return them of the proportions that represent the risk returns combinations most appropriate for the investor situations. Lifetime income. Lifetime lifetime immediate annuities converts an investment into a system of payments that last until the annuity owner dies. In concept, the payments come from three pockets: the original investment earnings, and money from a pool of people in the investor groups who do not live as long as actual tables forecast. The pooling is unique to annuities, and it is what enable annuities companies to be able to guarantee a lifetime income. Benefit to heirs. There is a common apprehension that if an individual starts an immediate lifetime annuity and dies some other Soon after that, the insurance company keep all of the investment in the annuity. To prevent this situation, individuals can buy a guarantee period with the immediate annuity. A guarantee period commits the insurance company to continue payments after the owner dies to one or more designated beneficiaries. The payment continue to the end of the stated guarantee period, usually 10 or 20 years, measured from when the owner start receiving the annuity payments. Moreover, annuity benefits that pass to beneficiaries do not go through probate and are not governed by the annuity owner. Well, type of annuities. There are two major types of annuities: fixed and variable. Fixed annuities guarantee the principal and the minimum rate of interest. Generally, interest, credit, and payments made from a fixed annuity are based on rates declared by the company, which can change only yearly. Fixed annuities are considered generally generally common assets. In contrast, variable annuities amount values. Payments are based on the performance of a separate investor portfolio. Thus, their values based on the my fluctuate daily may fluctuate daily. Variable annuities are considered separate account assets. There are a variety of fixed annuities and variable annuities. Some example, one example, the equity in indexed indexed annuity is a hybrid of the features of fixed and variable annuities. It creates a minimum rate of interest just as other fixed annuities do, but its value is also based on the performance of a specified stock index, usually computed as a fraction of that indexed total returns. The December 2008, the Security and Exchange Commission voted to reclassify indexed annuities with some exceptions as securities, not insurance products. Annuities can also be classified by marketing channels. In other words, whether they are sold to groups or individuals. Annuities can be deferred or immediate. Deferred annuities generally accumulate assets over a long period of time, with withdrawals usually as a single sum or as an income payment beginning at retirement. Immediate annuities allow purchasers to convert a lump sum payment into a stream of income that the policyholder began to receive right away. It credits a minimum rate of interest just as other fixed annuities do, but its value is also based on the performance of a specific stocks index, usually computed as a fraction of the index total returns. The December In December 2008, the Security and Exchange Commission voted to classify indexed annuities with some exceptions as securities, not insurance products. Annuities can also be classified by marketing channels. In other words, whether they are sold to groups or individuals, annuities can be deferred or immediate. Deferred annuities generally accumulate assets very a long period of time, with withdrawals usually as a single sum or as an income payment beginning at retirement. Immediate annuities allow purchase to convert the lump sum payment into a stream of income that policyholder begin to receive right away. Okay, thank you.